There's another element I want to make sure you know before we move on to the next lesson. And it is a crucial difference between stocks and futures. Let's say you open a brokerage account and you want to trade stocks. When trading stocks, the brokerage can lend you up to half the amount of the purchase price of the stocks that you have bought, but you pay interest on the money borrowed. This means that you're able to purchase more stocks than you would be with just your own money. So if you make the right decisions, you can increase your profits minus the interest charges, but that also means that if the stocks take a nosedive, you're on the hook for that money that you borrowed. So tread carefully. There's similar lending in the futures market, but it can be riskier than the brokerage lending in the stock market. To trade futures, you only need to put down 1 to 10% of the future contract's total value, which is the notional value. And then you can borrow or leverage the rest. While you still have to pay interest on the borrowed amount, the important factor is that you are exposing yourself to a much bigger payout plan if your futures takes a downward turn. Think about it, the difference of being able to borrow 50% versus 90%. The futures market has the potential to be a higher risk and higher reward market. I am going to illustrate the difference between the two markets with two hypothetical, overly simplified examples so you can get the gist. To keep things straightforward, I'm going to exclude commissions and fees, which would otherwise reduce profits and increase loss. Continuing with the pie analogy, let's say you want to buy as much pie from a company as possible. You have $200. Each slice of pie from this company, stock, costs $100. With a stock market brokerage account, you can borrow or leverage a maximum of 50% of the price of what you are purchasing. With borrowing, you are able to purchase $300 worth of pie, which means you are able to purchase 3 slices of pie. $200 of your cash plus $100 of borrowed funds for a total of $300. Let's say that tomorrow the price of this pie slice moves up or down $25. What does this mean for you? If the price per pie slice has increased from $100 to $125, and you decide to sell all your pie slices, you will have earned $375, $125 per slice times 3 slices, with a net profit of $75 after you pay back your borrowing. In the real world, you'd also be paying commission and fees, so this reduces the overall net profit. If the price per slice decreases from $100 to $75 and you decide to sell all your pie slices, the value of all 3 pie slices is $225. After you pay back your borrowing of $100, you'll be left with a net loss of $75. In the real world, you'd be paying commissions and fees, which would increase your net loss. Without borrowing funds, you would have only been able to purchase 2 slices for $200. And with this price change, you would have either have only gained $50 or lost $50. This is a simplified example of how stock market leveraging can make a difference in the amount you gain or lose. In the oversimplified example, you saw how borrowing a maximum of 50% of funds can impact your returns or losses. In the futures market, you can leverage so much more than that. You can borrow over 90% of the purchase price. Let's do another hypothetical, overly simplified example to show how the futures market works and how this borrowing can have a huge impact. In this case, let's continue with the Ryan Reynolds analogy. Reynolds has $200 to spend. A bushel of corn is worth $4. A future contract size is 1,000 bushel of corns, meaning that this futures contract price is $4,000. In order to purchase a futures contract, because of the nature of the market, Reynolds needs to put down 5% of the value of the contract. This 5% is called a performance bond, but we'll get into that later. So, to purchase this futures contract, he needs to put down 5% of $4,000, since the contract is 1,000 bushels of corn at $4 per bushel, which equals $4,000. 5% of $4,000 is $200, which, luckily, Reynolds has in his pocket. So, he purchases the futures contract. What happens if the price of corn goes up $1 or down $1? If the price of corn goes up $1, then the futures contract is now worth $5,000, which is an increase in $1,000 in value. If the price goes down $1 for $3 per bushel, the futures contract is now worth $3,000, losing $1,000 in value. If Reynolds decides to close his futures contract, which means sell it and collect the value, then he could either gain or lose $1,000, not including commission and fees. You can see how being able to borrow more means you can gain or lose more. Both prices in the stock market and futures market example moved by 25%. But in the stock market, you can only buy so many slices of pie with the amount of money that you borrow. Hopefully, with these examples, you can see how much more the futures market exposes you to risks and rewards. This is why it's important to understand the stock and futures market and all the jargon that's involved. It can be a fascinating learning journey into the world of finance, but the right mindset